is a technical analyst on our 34th floor. He's joined the firm over the within the past couple of years after being a technical analyst at a variety of other places. He's, as many of the other technical analysts, involved with a lot of regional discussions and conference calls. Now, last class, his talk was so popular that at 5 o'clock, or 5:15, I walked in here, and I said, you have to let people out of here at 5 o'clock. And everybody said, oh, no, we want to stay. So, what we're going to do is, at about 5 o'clock, he'll formally break so that those of you who do have appointments or whatever have to leave. Meanwhile, there's about 70 people on the other side of the classroom who are going to be joining you for the half an hour or 45 minutes that Ehab has volunteered to stay beyond his originally scheduled talk. My pleasure, Ehab Gaid.
Thank you. Okay, I usually talk without the microphone. I have a slight accent. If you don't understand or you can't hear what I'm saying, please raise your hand, and I think I'll be able to go over it. If anyone can help me deal with it. Now, in this package, I'm going to be talking about some of the stuff in here, and other things I'm not going to touch on. This package has also the studies.
This area where we have unless they take it to the other side. Unless this is into the system.
Fine. Okay, can you hear me now? Okay. They want to hear my voice in the other room. Okay, good. Okay, now down here in the training school, you take a lot of lectures about selling. This is the major function that you're going to be doing for the corporation, for Merrill Lynch. And you get a couple of sessions, or maybe 3, about market analysis. This is an extremely important thing, independent, of the job. You have, as an account executive, as a money manager, to be able to tell where the trend is going. Is that stock, is the market going up, going down, going sideways? What's happening? Okay? There are 2 schools of thought. First one is fundamental analysis, where balance sheets, financial ratios, yes. I think I have quite a few here. Should be kind enough. Thank you. Yes, sir. I'm going to get into that. Believe me, you're not going to get out of here before you will be completely guaranteed satisfied. Okay? I'm going to give you some golden rules, what we call golden rules in technical analysis, things that are very simple. It's very, very difficult for all of you, and you will experience that, to really go through all the material, all the published data about companies and fundamentals, and study each and every stock, and how many can you study? Okay, that's where technical analysis really has a lead. Okay, it's simple. Okay, it's not infallible, and nothing is. Okay, in the stock market, nothing is 100% assured. Okay, you always have, once in a while, the judgment fails us, and we can't fight that. Okay, now my name is Ehab Gaid. How do you do? Yeah. Ehab Gaid. My telephone number, please write it down, 637-8092, and please do not forget that we are in New York, 212. Okay. Now, the best recommended books, because I get this question so often, are the following, 2 of the best. The holy book of the field, okay, is Technical Analysis of Stock Trends by Edwards and McGee. Analysis of Stock Trends by Edwards, plural, and McGee, one word. Second best book is Well, there are so many good books, I shouldn't say, but this is the authority in the field. Second one is written by Martin Pring. This one is very difficult to read. This one is more comprehensive and a lot easier to read. And the name of the book is Technical Analysis Explained. This one, the Explained. The gentleman, explained it. Okay, let's read the first page. The first page reads, ages hence, when inhabitants of a far-off section of the world visit the ruins of the New York Stock Exchange, we wonder if their guides will say to them, here is the Temple of Mammon, 5,000 years old. Would the people who were then the richest on earth deluded themselves by thinking they could play a game then known as stock speculation without even knowing the rules? By Richard Wyckoff, one of the best analysts of all times. Now, as I started by saying, fundamental analysis mainly deals with published data and forecasting methodologies of market, of the stocks and companies from the published data by the corporations. Okay, they deal with the long-term debt to equity ratio, they deal with earnings and earnings growth and business growth, market share, and so on and so forth. Technical analysis, on the other hand, deals with the internal forces of the market. The stock market has been long known to be on the 10 leading indicators list of the Federal Reserve Board. It has not changed that rank among the 10, although many indicators came in and faded out. But the stock market came as one of the leading indicators to what's going to happen to the economy. In the free enterprise system, the stock market will discount what's going to happen. Never ever the stock market failed to predict a recession before it happened. Foolproof. And it always, when it gives you a decline, it is saying a message, and that message, no intelligent person in the field should just discard this assumption. At the same time, when the market is moving up, no matter how the bad news may sound, the stock market is a discounting mechanism, and what we look at as technicians, as technical analysts, is these internal forces. Now, it has been all well known to all of you is that when everything is known about the stock or about the market, people who studied business, undergraduate, economics, finance, what have you, know about the efficient market theory. The efficient market theory says the following. It says that if all the participants, if all the people in a certain game, okay, stock market, let's call it a game for a second. If everybody has the same information, if everybody know exactly what's going to happen, okay, then nobody can make any money, okay? So it's called the efficient market theory. Now, fundamentals. I'm just comparing, okay, between the two methods. Fundamentals talk about what has been published. If everything is good and nice and dandy, okay, then you know that everybody knows about it. What technicians do is they say, we're not going to look at what's happening. We're not going to look at the future. We're not going to look at what's happening with the company right now. We're looking only at the price behavior of that stock, that market, that issue, that security. What all they try to do is to determine or to answer these two questions. Crucial. When and when. When to buy and when to sell. If you know that, okay, you're approaching the concept of trends, and the trend is your friend. Okay? Always be with the trend. You go long in an uptrend, you go short in a downtrend. If you do anything other than that, you're responsible. Okay? Well, this would lead us to a little bit more talk about trends. Okay? Trends This is a trend, believe it or not. It's a sideways trend. Okay? This is an uptrend. This is a sideways trend. This is a downtrend, sideways trend. Now, in everything in life, I don't care what, and I challenge all of you. Mention any subject. I'll give you instances of cycles. Your mood, your behavior, your happiness, your success. Everything goes in cycles. Now, these cycles could be in a secular uptrend, meaning you go through cycles, less success, but still ahead further, higher. This is a secular uptrend or a secular downtrend. Okay? Everything goes in cycles. Okay, you have the 4-year cycle, okay, which is a presidential election year cycle, what we all know and heard about. The 9.5-year cycle, okay, and this is called the kitchen. That's the guy's name, kitchen cycle. Kitchen. That's a nice word, kitchen.
Look at a lot of that, not all of it.
And you have the 25 years, or the Schumpeter cycle, and you have the 60 years cycles, and these are the long waves. Okay, we're not here to talk about cycles, and this is a whole study all by itself. We're just here to give you a flavor of technical analysis and how to determine or to solve those two dilemmas, the one and the second. When and when. So this is a trend which is sideways, as we started saying. Okay, and this is another trend, which is, this is sideways. Okay, I'm not going to write anything yet. Okay. This is a trend, sideways trend, up trend, down. Right. Now, if you look at any typical chart, what is a chart? Technicians look at charts. They look at the internal forces. The market is a discounting mechanism. The market is the sum total of all the knowledge and ignorance of all the participants in this or that issue. Okay? So if you look at the price behavior and what chartists do, okay, of a certain stock or market, they will see bars. What do these bars mean? Well, any stock on any day, any given day, will have a high, a low, and a close. Could be here, could be here, could be here. Okay? So you draw these daily bar charts. You can also have weekly bar charts of a completely different meaning. You can also have a monthly bar charts, completely different meaning. You can even get a point and figure. I don't care about the time. I will only make an entry only when there is a reversal of one point. And it's very nice and neat. You have some examples there where you will see, very nice. Has no time on it. So you do these bar charts. Okay? Obviously, these bar charts are provided by so many charting services that you could subscribe to, $500 plus, and it's no secret you have to pay for that. Okay? Nobody pays for that. All right? Pay $500 for that. I will give you some golden rules you're going to like now. Okay? So the price of the stock will move like this. Just rough example. Any stock, any market will move like that. Let's go for a couple of seconds over the psychology that prevails while all this is happening. It's a random thing that I have drawn, and all what we're trying to identify is the trend, which is your friend. Okay. I apologize for this section because I give my back to this section and I see a lot of comments on that, but okay. Now, the stock will go into dormancy. Let's start from a stock that is dormant. Fundamentals do not look enticing, they don't look good, and the chart is just dormant between, buying range 5, 3, back to 5, 4, 6, back to 2. So it's doing absolutely nothing. Some of the bankers, some of their relatives, okay, who know these bankers and they get their tips, okay, some of the insiders of the corporation, okay, some of the guys on the floor, okay, the market makers. They have to buy when nobody's buying. They have to sell when everybody's selling. They have to buy when everybody's selling. They have to sell when everybody's buying. So look at how unfair they are being treated, the specialists, the market makers on the floor. And this is where internal forces would start meaning something to them. There is always a market maker to stabilize maintain an orderly market. So this is what we call as technicians accumulation process.
Fundamental research.
Accumulation is what it means. Accumulate stock, take a position. Okay? Then the stock breaks out. Okay? Consolidate, keeps moving in an up channel. Okay? Then it goes into a topping formation or distribution, and then starts declining, and that's a down phase, and then back again. Now bear with me, at the end everything is going to be so clear. You're going to all know how to identify the trend the simplest way. You don't have to listen to any of the gurus on Wall Street. You'll be able to do it yourself. Now, a typical psychology that would prevail during those four phases would be, okay, on the news, on the ticker tape, whoops, most active, that stock made 2 points in one day. Immediately attracts attention. What's happening? Hey, that stock is going up. Went down. Well, it's improving. Let's check the fundamentals. Oh, I can't miss that. Buy. Okay? And I'm talking about, it could be here, it could be here, it could be, some people would even buy here, okay, some people would buy here, and what? Should I sell here? Okay, and they will sell it right there. That's where we have support and resistance. The chart is drawing itself. Okay? Get in somewhere here. Good. We'll hold it. The fundamentals look good. Okay? Most likely the fundamentals here did not really come into the picture. In most cases. Okay? So, we'll hold it. Whoops, what happened here? It's coming back. Higher, higher. I talked to the analyst. What the hell is happening here? That was a whip. Okay, well, I'm not going to get scared. I'm not chicken. What is this? I'm even now. Should I get out? No, I'm at a loss now. What the hell is happening here? Oops. Okay, I pray God. Well, I'm going to stay. I'm going to be an investor. Okay? Then that process of accumulation could take a few years. Okay, a person who was in the range, let's say 35 years old, he or she, okay, your interest in life different. You didn't have children, you got children. Children went to school, went to universities, and that thing is still damn it down. So yourself, when those people start selling, when that whole distribution process, and not only the people who bought here, I mean, some people bought here and they got greedy. No, we still have a filter. Well, I'm breaking even, I'm losing. Well, I'll stay. Those who bought here, well, it will come back. You know, it will come back. I bought so cheap. Okay. And those who bought here, round trip. And sometimes more. Okay? So you look at all these combinations of in and out, okay, and now how would a fundamental curve, I'm just trying to speculate. It doesn't have to be an exact thing. How would the fundamentals look if you applied the goodness or the badness of the fundamentals on that chart? Fundamentals would lag. Again, efficient market theory. If everybody knows the good news, okay, nobody can make money on that situation. Okay, so the fundamentals most likely would be, well, this is coming from up, remember, okay, and this could be a few years or a few months, okay. Fundamentals would be something like that. Okay, a little bit lagging. That's why the market is a discounting mechanism. That's why all these internal forces of those who get the news or the tips or the banker who knew that chairman of the board and the plans, who's calling the VP of finance, VP of marketing, ta-ta-ta, let's push, let's acquire this company, and the whole fundamentals improve, but the price has discounted that whole move, or a big part of it. Okay? Now, accumulation, up phase, distribution, down phase. Now, talked about that. These are the trends. When to buy and when to sell. I didn't get to that point yet. I'm starting with the trends. And the trend is your friend. All right. Okay. Good. Always remember that. Okay, you are with the right trend, with the right flow. Okay, you'll survive. Even if you buy a little bit on a blip, even if you buy on an up day, a big extended position, still, as long as you are with the trend, you have some kind of indication that it will go still higher. It will go your way. You will not lose. The problem will come on one of these blips. You say, oops, it's starting now to reverse trend. Okay? And you get in, you ride it low. A lot of people buy on decline. It's a very wise strategy. But you buy on decline with the trend intact, up. Okay? How can you determine, locate the trend? Give me just one more minute. I'll get to that. Okay, then you get to technical analysis as a school. We talked about trends and technical analysis. You have two approaches. And by the way, many of these things that I'm saying are not in my notes. These notes are just words here and there, keywords to remind you what some of the things that have been said here. There is no replacement to personal attention. Wake up, it's 5 o'clock. Okay. No, it's 4:30. Top-down approach. Top-down approach. One of the masters in this business, okay, is Bob Farrell, the head of Technical Analysis Department of Merrill Lynch. One of the masters in the field, if not, if I allow myself to be biased, the master. Okay, and the other one is the bottom-up approach. I'm mentioning this because I take notice of some of the questions, like last class, okay, I received a question from a gentleman who said, who would you suggest, okay, that I subscribe to? Marty Zweig or Stan Weinstein? And they're all technicians, by the way. I mean, this is just an observation. Most of these gurus are technicians. Marty Zweig teaches in one of the universities finance classes, fundamentals. But when he does his market timing, he talks about momentum, sentiment, technical, timing, when and when. Okay? Now, what is the top-down approach is what the market is going to do. Okay, I assume that the stock will do the same. Okay, so if the market is going up, so this deals with the market. This section, market, top-down approach. This one is the bottom-up approach, which is stocks, individual stocks. Okay, bottom-up approach. Okay, you look at, and once you have written this down, it's not in the things. You may be missing something. I'm telling you. Okay. Now, let's get to the top-down approach. What is the top-down approach? You look at what we call market indicators. Top-down approach. Sounds like a drug, TDA. Okay, and you have mainly three areas. First one is money. Money matters. Second is momentum. Third is sentiment, psychology. Okay? Now let's talk about the first one. While keeping your eyes on the stock market, don't only look at the Dow Jones. The Dow Jones is only 30 companies. Look at the S&P 500, because this is 500 stocks. Now, before I get into that, and if you have a couple of minutes, I think we have a couple of minutes, we're ahead of the time. Okay. How did it come about, those Dow Jones, and where did it come from, and all these things? Well, back in the early 1900s, the editor, okay, of the Wall Street Journal, his name was Charles H. Dow, got together with his assistant, Dick C. Jones, and they studied trends. What they said was, it has been noticed that these cycles move or flow, okay, together. And at certain junctures, the markets will move up and everything will go up with it. Okay, at other junctures, the market will go down and everything will go down with it. The cycles. So they said, let's index them. Okay? Back then there were about 18 companies, okay, and I'm not sure, don't quote me on that. Don't quote me on that on the machine, okay? 18 companies, and what they simply did was they added the price of the 18 companies, okay, and divided them by 18. That's a linear indexation. You can have a weighted indexation where you can factor in the number of shares or the capitalization of each and every company. Okay? So they created this index, which is the Dow Jones DJIA, Dow Jones Industrial Average. That's where it came from. After that initial invention or creation, other analysts came along and said, well, let me go for the Standard & Poor 500. S&P was credited for the 500 and 400. Okay, the 400 are the 400 industrials, and you add to these some utilities and transportation. You can also index Dow Jones Transportation, DJTA, or DJTA, and so on and so forth. And you see the relations of these markets. If one of the market is going down while the other market is going up, this is what we call, okay, divergence. So this is one of the things you have to get a feel of. Another thing that you have to watch as far as markets is the bond market. Golden rule number one. Never ever the stock market went up while the bond market was down. Never ever in history you will not see it. Okay? Never ever the stock market went down while the bond market was moving up. Okay? Why is that? What is the bond market? Well, the bond market is very sensitive to interest rates. Okay. What is interest rates? Interest rates is the heart, soul, and life of the free enterprise system. Yes, we are technicians. Look at all these chicken bars. Okay. But interest rates is one of the indicators very, very closely watched by professional technicians. Okay. Interest rates is the soul, heart, brain, life of the free enterprise system. You want to cause the depression? Next week? Okay. Push interest rates to 500%. As simple as that. You push interest rates to 500%, an immediate collapse in whichever nation that starts that, and is going to propagate the domino theory into other free enterprise systems, interrelated through international trade, and so on and so on and so forth. You want to cause tremendous boom. Market will just 5,000%. 5,000. Dow Jones will go 5,000. Lower interest rates to minus 25, which means we'll give you 25% if you borrow from us. But that will be at the expense of inflation. Okay? So interest rates extremely important. As a matter of fact, if you look at the interrelation of the three markets, interest rates, bonds, and stocks, okay, you will see that this is interest rates. Okay? This is the bond market. As the interest rates are declining, bond market starts moving up. Okay? And the stock market will take its lead from the bond market and will be a little bit lagging effect. Always, this chart, by the way, is in the package. So always keep your eye on all these averages, on the bond market. Also, what would give the lead for the bond market? Okay? That interest rates could be heading even further on the downside. Two things. Foreign exchange, the fate of the dollar. Why? Why does the dollar go up? When does it go up? It goes up if interest rates in the United States is higher than in Germany, providing that inflation rate is at the same rate. Why? Because if interest rates in the United States is high, while interest rates in Germany is lower, then people will be buying dollars, so demand on the dollar will increase while the supply is the same. Now this cannot continue because it hurts international trade, so the Fed most likely would ease on interest rates and so on and so forth. These are basic economic fundamentals, and we're not going to get into that. It's just my desire to illustrate to you the interrelationship in all these markets and how do they affect each other. So you watch all these markets. Interest rates, money, and the bond market, okay, and the foreign exchange. Momentum. Some of the momentum indicators, okay, are even reported on your page. Which page? My page? Well, I have a Cotron on my desk. How can I get it? Well, I do the following. I put QIQ, write it down. It's not in the package. .10, £V. What do you get? You get what we call sentiment numbers. Okay, one of them is related to momentum, and it's called 7-DAD. And I apologize for the ladies. We couldn't call mom. Okay, 7-DAD is 7 days advanced decline. What some of the technicians said or thought about, and they thought about a lot of indicators, that will indicate the trend of the market. Remember, when, trend. Golden rule number one, bond market never ever contradicts the stock market. Always in sync. Okay, if the bond market starts moving up and the bond market is declining, if the bond market is moving up and the stock market is declining, you know that that decline is reaching. Okay. You have how many components? During any single day, you have advancing stock, you have declining stocks, and you have unchanged stocks. Can anyone see me here? Okay. Advancing stocks is the number of advanced, declining stocks, the number of declines. Okay. You take the differential, which is advanced minus decline, okay, and you get a certain number. Okay. Now, if this number is positive, you know that the number of advances are exceeding the number of declines. This means that this market is tempted to move up. You don't have a declining market. If the Dow Jones is down 20 points, minus 20, and the advanced decline is positive, the number of advances is 600, let's say fictitiously, okay, or 800 in today's versus 600. This market does not look bad as that Dow Jones is trying to fool us. The majority of stocks went up. Okay, well, technicians did the following. They said, well, let me take that advance minus decline, okay, for 5 days. Take 5 readings and divide by 5. And we'll get something called an oscillator. Okay, you can apply it on 5 days, you can apply it on 7 days. Advance, decline, and that becomes the 7-DAD. And they go from overbought, oversold. Parameters, you want to take that down? When the 7 days advanced decline is minus 1.5 or lower, that's what we call oversold, and it means that the decline is tempted to stop. When it's plus 1.5 or higher, we say that that's overbought and that advance is tempted to reach a wall. Now, in strong bull markets, an overbought condition could continue to be overbought even further. An oversold condition could get even more oversold in a declining market. Now, this you get on the QIQ dot and #V. You can also get the 5 days advanced decline, okay, through other channels like trend line. You can get the 10 days advanced decline oscillator through daily graph. Okay, these are other charting services, and they include them in the package. Okay, and they move from overbought to oversold, overbought. Now, what are the extremes of these? Extremes of these are minus 2.4, and that usually is a solid bottom. If it's more negative than 2.4, the 7 days advanced decline on your Quatron device, that's a very solid bottom. You do not expect the market to just jump right ahead, but the bottom is within reach. You know that the momentum on downside has been controlled, or is reaching the oversold controlled level. By the same token, if this one reaches plus 2.4 or higher, that's also overbought. However, in the bull market that we have seen, August 1982, the initial thrust was plus 3. Okay? Now, this is one example of the momentum. What other momentum things do we look at? How about this? The U, unchanged stocks. On any typical day, we said advance, decline, a number of stocks unchanged. If the market is zooming day after day, 20, plus 15, plus 13, plus 25, and the number of unchanged is increasing, what does this mean? It means that more stocks are hesitating to move with the market. So this is a phony. The momentum is not there. By the same token, if you have minus 20, minus 19, minus 16, minus 35, record day on decline, and the unchanged keeps rising, what does it mean? It means that a lot of stocks are hesitating to decline. So the momentum is not there for a decline. You know that you're reaching some kind of a bottom, okay? Intermediate, short. So these are the interpretation of these two. What other things do we look at as far as momentum? I'm going to get in just 1 second into the moving average type of things. Okay, the relation of the 30 days advance decline to the price of the stock. Just take it for granted. I'm going to go through moving averages and what they mean and things like that. And this is the promised thing that I'm going to give you, which is to be able to determine what the trend is, okay, without any help. Now, by the way, I should mention something. We do give conference calls from our department to each and every office of Merrill Lynch. We confer with you once a week. If you don't know your market analyst and when the conference call is, please go back, ask the manager of the office, he or she, to tell you when is the conference call with the market analysis department. During these conference calls, we give the long-term trend direction, the short-term trend direction, okay, some observations from the technical side point of view, and also give you specific recommendations as to groups to buy, stocks to buy, and stocks to sell and groups to sell. Also, there will be, at the end of each conference call, some time where you can exchange questions with us. What's happening with Federal Express or IBM, and tell you, well, it's consolidating, support is there, intermediate term is positive, short term could possibly dip towards that. The moving average is moving higher, whatever connotation that, or whatever terminology we're going to be using. So take advantage of that, because that's what our department is. Hi. Okay. Why are you smiling? Oh, you like it? Very good. Okay. All right. Okay. Now, let's go back to momentum. So the relation of the 30 days moving average, okay, to the price, again, it gets into oversold and overbought territories, okay? And just keeping this indicator, okay, myself, during this decline, last 4 weeks, okay, that indicator got more oversold than the October 1979 massacre, February, March of 1980 massacre, and September of 1981, which was the worst massacres, okay, in the recent history, the last 2 years. It did not quite go to the extremes of the 1978 massacres, but it is screaming oversold. It is saying that the worst has been seen, at least as far as this indicator. Again, repeat, it's not a perfect science. It's one of an overall picture that you look at. Okay, it's no single indicator will be taken, okay, as foolproof. Okay, and technical analysis, the weakest point of technical analysis is judgment. If you make the wrong judgment, it's a double-edged sword. Okay, if you misinterpret the trend or the message, okay, that's where fundamentals will be more superior, because you know that these are published data, okay, according to the disclosure regulations of the SEC. Okay, so these are the momentum things, okay. We also look at the psychology in the marketplace, sentiments. Sentiments, when the majority is bullish, okay, most likely the market will decline. When the majority is bearish, most likely the market will advance. Why is that? Again, it falls within the realm of the efficient market theory. Okay, the market always sees ahead, does not hear the news now. Back in 1982, right at the bottom, the deficit on the news every day. Okay, the decline in industrial production, all these things, and the market just kept moving up. Everybody said it's a flash. No. It kept moving up, and everybody got in. February, March, remember this chart? Okay, so the market is a discounting mechanism, and people get most bearish at key juncture points. Okay, again, the market does not accommodate the majority. Now, a lot of these sentiment measures are reported to you on the QIQ 10 page. For example, how can you measure the bearishness, the psychology, okay, the contrarian theory? Well, you have people who are bearish, usually short. Okay? So one of the measurements is to measure the short to cover ratio of the round lot, which is reported as RLSC. Okay? That figure, there are no parameters. It could reach as high as +6. Okay? But at least it will give you the feel of the sentiment. Is it bearish and getting bearish? Or is it just bearish one day? Okay, you constantly hear about the market is squeezing the shorts. Okay, and shorts is short versus covering. If this fraction is higher, or if this division is higher than plus 3, you know that from the trend. It's several readings of this that will give you some kind of market psychology trend. Another one is the put to call ratio. If people are bearish, what do? They buy puts. So put to call ratio is another indicator that you get. Now about this one, well, 65, 75% or higher for several days would be a very good indication, okay, that the momentum of the psychology is so bearish that we can hold that decline for the time being. Another one that we'll look at is the MLSS, Merrill Lynch short sales ratio. Merrill Lynch is the largest firm on the street, okay, and we believe that the clientele of Merrill Lynch is so big that it warrants paying attention to it. So we can measure the short sales from the Merrill Lynch data, and Merrill Lynch short sales ratio gets reported to you if on a weekly basis it gets to 0.2 or higher, meaning 0.25 or 0.3. That's a very solid bottom. Yes? This, again, I'm in the market analysis. I'm in the top-down approach. You're trying to feel what the general market is going. The general market is going, okay, taking its lead from this.
When you said the advanced decline before, you were looking at absolute numbers plus or minus 0. Are we looking at the numbers here plus or minus 0, or are we looking at trend in the numbers in terms of whether they're...
Trend in numbers, but this one happened to be 0.2 or higher is very, very solid bottom. Especially on a weekly basis. If you get it a couple of weeks in a row, it's a very solid bottom. Yes, yes. What we have done is just take this indicator, plot it against the Dow. See at each bottom, which one confirmed which one. This one, all the time. Yes, 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 yes. Bottom. Bottom. All right. Okay, bottom. B-O. Okay, fine. Now, so these are the sentiments. This way you can get a feel of the market. The market psychology. Is it bearish? Like, for example, last week you saw the first time, hey, what the hell is happening with the bull market? On the front page of the Barron's. So people are getting, you're hearing a lot of very famous analysts talking about the bear market. Okay? You're getting into the budget deficit, which was with us for the last 3 years. But only suddenly, let's find the reason. Okay? So this is developing now. It doesn't mean that once you start hearing that, okay, that, no, but it will mean that, you know, we're getting there. If you're not looking for the last point, and I don't believe you should, okay, you're very close to that bottom. Even if it's 20, 40 points away, still, you're buying a trend, okay? Now, we'll look at all these things and we'll try to determine if the market is going up, going down, going sideways, okay? Once we have determined that, we say, well, if the market is going up, buy. Okay? That's the top-down approach. That's what most people go by. They say, what's happening with Dow Jones? Dow Jones is up 20 points. So why is my stock down? That's when you get into the bottom-up approach. Bottom-up approach says, I don't care what the market is going to do. If my stock is doing fine, I don't buy the averages. I'm buying a certain stock. Okay? So, this is where the second and best golden rule that you learn, okay, from this session comes. Now, hear me well, I know it's 5 o'clock, we have all had lunch, it's heavy, but please. Now, we go back to our daily chart, okay, and let's say it goes like this. I mean, our monthly, over a period of time, okay, and what we talked about. Okay. What technicians did was that they said, well, fine, this is a lot of, confusion. How can I get, any kind of lead of trends from all these jiggles, okay? It's just too hard. Let me add up the price for the last 200 days. We add the price for 200 days and divide it by 200. Fine. And superimpose the two charts, one on each other. They will get something like that. golden rule number 2, okay, and the most important one, okay, buy here, sell there. A downtrend is the price of the security moving below the 200-day moving average. What most people make as mistakes is to buy here on declines, thinking that, oh, we're changing trend. As long as this is declining, the 200 days moving average sloping downward, this is still a downtrend intact. Same thing, if you get to your stock like this, but this is still up, the slope is up, this is an uptrend. Okay? If you just follow this trend as a method, once in a while you will get, okay, intermediate corrections where these will flatten out, but they will not move down. They will flatten out and then resume as the stock goes back into the channel. Okay? Ma'am? Clear? Okay. That information you can get it. There is one of the most excellent chart services called Mansfield Chart. Okay, it's in New Jersey. And by the way, maybe I should mention that. Okay, at the end of the training or somewhere along the line, you will be visiting departments. Please visit us because we will show you other things that could be done on personal computers, which some of you might be interested to know. Plus, we may be able to elaborate a little bit more on formations, triangles, head and shoulders, and show it to you as it's happening on IBM chart, on any chart. I mean, up till today, as it's happening today, will prove that these formations do work sometimes. Now, what you have to watch for is not only the crossing. I mean, here during this period, you will see the price of the stock fluctuating back and forth. You will see it going first horizontal, tilting upward, horizontal, downward. You have to keep your eye on that moving average. When it starts moving horizontal, it's a weakening of the momentum. I'll get to your question in a second. When you're seeing starting definitively, especially the 200 days is very, very, very reliable when it comes to trends of few months at least duration. If you want to go for shorter term type of trend, okay, there are other moving averages included in the Mansfield chart where you will see the 50 days moving average. Now, we would expect the 50 days moving average to be moving more choppy, okay? And the 50 days moving average would be moving closer to the price, so it's above the 200 days moving average in an uptrend, below it. When the two moving averages cross, that's another buying signal. But you only buy when that 200 days is tilting upward. Okay? With this rule, you really it's really simplifying the whole science into 2 words, and it is quite reliable. You will not be able to call the terms like the high professionals who look at also other things like unbalanced volume, relative strength, comparing groups to stocks, stocks to groups, groups to groups, groups to stocks, stocks to averages, averages to stocks. Okay, all these combinations of, it's a matrix, big, big matrix, and this is for the full time. You really need to concentrate on the selling. All you want to be in is the right trend. Now, before I get part of your package, I'm going to finish in 2 seconds, in 2 minutes. Just give me 2 minutes. Any question? Do you have any question? Yes.
I just have one question. I was doing some reading and it seemed that the general consensus among analysts is not selling enough critical commodities and stocks. Are there any specific indicators in the stock market which would go against that theory of selling enough?
To sell in uptrend?
Right, or do you always,
It's very difficult.
you always assume that it would be uptrend and go with it?
I believe it should be with the trend. One of the indicators, thank you for this question, one of the indicators that we look at is the percentage of services bearish. Wait a second. You're telling us now that you are going even against the professionals? That if the percentage of analysts who are bearish is too big, this means that the market is going to turn? Yes. Why? Because analysts are trend watchers. Okay, many of them fail to recognize key juncture points. That's all you have to identify. In a stock, in the commodity, in a market, is these key points. They have characteristics, believe it or not. Bottoms do have characteristics, especially major key juncture points. Major cyclical lows, major cyclical highs. Okay? And that's where many of the analysts, for some reason or another, okay, fail to. Yes?
On 200-day moving average, I understand the time of buys when it's going up, the time of selling goes down. Does that also coincide where it crosses over the price average?
Yes, definitely. When they cross here, that's a selling. But if they cross while that one is sloping still upward, this could be a whip. You stay with the trend. Okay? Any other question? Okay, let's move very quickly and I'll open the door for questions. In your package you have also a whole study ran by Arthur Mell, okay, a very famous analyst, okay, he has his own firm, very famous in the technical field, where he ran study on all kind of combinations. He studied the market for the last 500 years, okay, well, not 500 years, but so long, and he identifies seasonal patterns, okay, during the month of January. How many Januaries for the last 100 years, okay, did the market go up? How many times did it go down? Even on a weekly basis, how many times on Monday the market went up versus Tuesday going up, okay, percentage. The seasonality moves. Another thing that you looked at was how many times did the market open higher the next day after it has been down minus 10 the day before. All kind of very interesting statistics. You know, when you go back home or in the subway or, you know, when you have some time, just take a look at them. Again, they are not infallible. Now let me apply only just a couple of very quick hints, because I'm not sure that other lectures do cover that aspect, okay, of the whole investment process, which is portfolio management, at least from the technical analysis point of view, and not infringing on my colleague who's going to be giving the options session. He's just applying option strategies, just one or two of them, on technical analysis, on charts. Okay? Now, first, we're going to talk about portfolio management. Portfolio management, first consideration is the age group. Okay, if your client is 50 years old, she or he, you should not be playing options. It's not prudent. The rule of prudence should be applied. Okay. At the same time, if your client is in the 20 to 30 range, yes, that person can accept, okay, 40% possibly risk, okay, max. Okay. Where if he or she would like to get into options, identifying the risk involved, still those people would have, you know, enough time and chance, okay, and most likely they are not married, engaged, or what have you, so their responsibilities are different. Okay, so these are age considerations. 2, okay, is the investment objective. Can anyone contribute to what is meant as investment objectives? Right, objectives. Okay, so the person, the risk-taking attitude of this or that person should be taken into consideration. Some people are risk-averse, some people are risk-takers. Okay, 3 is tax bracket. Okay, and by no means I mean to talk about taxes, but tax bracket. Okay, you want to you don't want to trade for an account which is $500,000 or more. Okay, because it's too heavy to trade with. Okay, you want to position part of it. Okay, for the long term, especially for the tax bracket. Okay, 80% net. Okay, gain for the long term versus more than 50% depending upon the state and city local taxes. You can reach in short-term capital gains up to 70%. In New York, it's in this area for very high. So tax bracket should be dealt with in conjunction with the size of the account. Now let's get into a trick. Gave you 2 golden rules and a trick. Okay, the trick is, okay, we said this is a trend. Well, Ehab, what you said was right. The moving average started tilting, and that thing kept moving up. Very good. So I bought it here. Still moving up. The trend is up. Very nice. Bought it at 35. Okay. Now, I saw this. 45. Blip. Sometimes, all the time, you'll see that on the charts. Okay. Sudden move. Tap, 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 tap. Goes 45. Just give me 2 minutes. Yes. It's not going to be continuation. It's going to be an open session for questions for anyone, any person who has any question. Right? Okay, just 2 minutes and I'll open the door. Fine. Now, So you bought the 35, that stock is optionable. Okay, what I would do, okay, is that stock has run too fast, too far. Now apply this to Coleco. Okay? What you do immediately is you write the covered calls on the 45. What's wrong? What's wrong with that? You bought it at 35. They want to take it from you at 45. God bless. Take it. Okay? You go for the furthest away contracts. You get the heftiest premium you can get. Okay? And you take that premium, which is not coming from your pocket. And you buy the puts right in it. You are guaranteed 45. Even if the stock goes to $6. God bless you all. Those of you who want to stay, it's going to be an open session, and please visit us on the 34th floor. Okay.